Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. We are recording this on Thursday, the 20th of August, and I'm delighted to be joined here by Anwiti Bahuguna, Northern Trust Asset Management. Welcome, Anwiti. Great to see you here.
Thank you for having me, Aoife.
Well, with no further ado, let me pull up the slides. Called this week's podcast a Ferocious Ferragosto. We're recording it in the second half of August. It has been a tumultuous summer by all accounts, with plenty of deja vu, but also plenty of new information for markets to contend with. As usual, we'll discuss on this podcast inflation, interest rates, geopolitics, equity markets and other asset classes. And we're going to look about how inflation has bled into bond worries, and they've been particularly acute over the course of this week. We'll look at some of the breadth in equity markets, particularly as it pertains to emerging markets. We'll also reflect on how geopolitics has failed to stir markets. And in the case of looking at some of the equity market developments and how venture capital and private equity has really started to accelerate in areas such as tech, we'll ask whether the pace of change there has become very extreme. And as always, look at portfolio implications. Here's Anwiti, Co-CIO Global Investments at Northern Trust Asset Management. And let's kick off, Anwiti, with it's a bit of a broad topic really on inflation / bond markets and where we are in terms of an economic vibe check. So plenty of news around inflation over the summer, bit of maybe a head fake, we could say. In June, it seemed lower than many had expected. That seemed also the case in July, a little bit lower than many had expected, but disappointing for the most part regarding low hiring, low firing in jobs, and now a suggestion that rate hikes are not likely to be as much on the table as before. A lot of economic news there. I'd love to get your view in terms of where we are on the inflation continuum, and equally then how this will relate to potential rate hikes.
Thank you again, Aoife. I'll say that I love the chart you have on the City Economic Surprise Index because it encapsulates hundreds of data points that are released in a quarter. And it's very clear here that we are beginning to see the surprises head back to zero. In other words, the economic momentum or the ability of the data to surprise the markets has trended downwards. And that's true of inflation also, because as you mentioned in June, the inflation numbers have started to head down and surprise the market on the negative rather than on being higher than expected. So we look at several different measures of inflation, and looking through it, one of the things that struck me, Ifin, was that the cyclical measures are showing the downturn that you're seeing here. So cyclical components of inflation, if you break inflation into those driven by cyclical factors versus those driven by structural factors, we're seeing the cyclical component come down as the economic environment is softening a bit. But the structural forces are still very much there. And so the question to me is, can the Fed do anything about the structural forces? So the cyclical forces are what you would expect in terms of, is growth moderating a little bit? Is wage income coming down a little bit? And the structural forces are things like geopolitics, tariffs. Those things are completely out of Fed's control. And what we're seeing here on the inflation front then is the fact that economic momentum is slowing down, which means yield should come down. But those structural forces are still very much in play, particularly around long-term debt and deficit, which have an upward pressure on yields. And that's the dichotomy we're seeing in data at the moment.
Yeah. And you mentioned within the Fed's control, I think this is a very interesting point. There was a suggestion that increasingly, particularly as the new chairman pulls back from telegraphing and from the more kind of drip feeding of data and information to the markets that Jerome Powell had in place, as the new chairman pulls back from that there was going to be even less that the Fed could control, that the bond market essentially would sort of take its own, take a lead from its own read on data, and there would be even more of a disconnect. Do you perceive that that power may be slipping a little bit on the part of the Fed to maybe control, whether it be inflation, the bond yields, etc.?
So I have been parsing through the last few months of Fed talk, and markets very divided in terms of their commentary of this is a mistake, they should be talking more, versus this is amazing, we had too much talk. What I perceive this to be is more the fact that we have a new Fed chair and he is still getting used to communicating with the markets. And I think we will see it mature over the next 3 to 6 months, even, and find equilibrium on the amount of Fed speak and Fed communication that we haven't seen yet, because it's still very early days in terms of him having given just 2 press conferences. In terms of your question, though, of what the Fed can control and what the Fed can't, we know very much that Fed really operates on the front end of the curve. In other words, what can do with Fed fund rates and really the very short-term part of the money market. They don't really control what happens on the back end of the curve. When I was talking about inflation, though, I was focusing on even the components of inflation which can be controlled by having a restrictive policy, which is what they can do on the front end. They can increase rates, make policy restrictive, and try to have an impact on the cyclical part of the economy. But they really can't do anything on the front end and impact geopolitics or tariffs or things which are really at this point more structural issues.
And it's really interesting. I'm just looking, I know that you have a multi-asset portfolio that you recommend. How would you, therefore, would you be overweight or underweight within the fixed income complex, given some of this potential movement in bonds that we're hearing?
We are very much short bonds in a multi-asset in our multi-asset portfolios. We recommend equities over bonds. This has been our stance for more than a year now. Initially, really because inflation was a big fear, and anytime markets worrying about inflation and looking at what they get from their bond portfolios in real terms, you would rather be in equities than in bonds.
And I think it's interesting that you mentioned some of there's the bond activity and the reaction to growth and potential. There seemed to have been a real kind of Jekyll and Hyde kind of switch going on this particular week. We had, on the one hand, long-dated government bonds rising across the board, the UK, US, France, Germany. This was maybe to the chagrin of Scott Bessent, who would have liked to have them a little bit more under control. Some of that may be related. We saw the Japan yen intervention just a few weeks ago. Maybe that was motivated by not having any large holder of US Treasuries sell off. And then the contrast to this is what we see in China, where the bond market there was falling to a 13-month low, having been in the US at the 30-year at a 19-year high. They're really responding to weak economic growth. So I suppose my question is, does this suggest that the market is either confident in the growth figures we're seeing, and then contrary to this, what is going on in China?
Sure. I'll start with the bond market reaction, which was on your previous slide, because that is indeed very interesting. And we saw 2 instances in August of intervention from the US Treasury. One was supporting the yen through being very supportive of the Japanese attempts to control their currency. And the second was a bit more, and I would say it's just a tiny bit more, even it's not moving the markets enormously, of bond buying on the long end here in the US. All of this are really in the realm of, again, those structural factors that we talk about. The debt scenario, even headlines this morning were that US hits $40 trillion of debt, is beginning to worry the markets. And on the long end, not on the short end, but we've seen steepening of US Treasury curve, and we're seeing those debt worries show up really globally across the world, but very much led by worries about what's happening on the deficit side. These are not cyclical factors. So what's happening here is, again, structural. You could interpret it as, if economic growth is so strong, over 3%, should one not then see the economy able to tolerate higher yields, and therefore it could be seen as a sort of verification of the good data that we have seen so far in the last 2 years coming out, not just in the US, but globally. Now, the China scenario seems more cyclical to me because of growth worries in the recent years. And really, again, they are reflecting of the economy, again, not what's happening on the equity side, because if you've been following the not just China, but overall EM space, economic activity has led to good earnings, good enough that you're seeing this divergence between what's happening in the bond market and what's happening in the equity market. Not too worried about it. We are overall in our portfolios recommending that clients are still long EM.
And I think what this illustrates really is just somehow we can't really predict how bonds will behave in a portfolio. Sometimes they're the flight to safety, which they seem to be providing here in China. On the other hand, they reflect that kind of niggling concern that equity markets conveniently forget at times, which we've seen in the US, whereas the bond market has been maybe the only siren call of alarm when the equity markets have been feeling quite buoyant. And we will touch on emerging market equities a little bit later. So just getting back to your positive stance on equities, and clearly we've seen this dichotomy here, bond market, some concern, equity markets very much loosening up their concerns and actually doubling down, you could say, on their momentum and on their conviction around AI. We've seen new heights being reached just over the course of the past week, and also generally broad gains with this chart here on the left, I think is interesting. Even if we exclude AI, we've had a very robust equity market, even excluding tech. I think that illustrates the breadth that's been returning. We've also seen this low volatility environment, which is good for investors. The exception, of course, being something like chip stocks, which are displaying this stark volatility because of perhaps some of the momentum behind that. So quite a lot of mixed factors going on in equity markets. I note again your high conviction there in the US and in EM. What's your take on where we stand today, given some of this strength? And do you think it's again that I think the probability of recession is almost gone to zero now? No, I think the no landing scenario is back in vogue. Are you still as high conviction in equities as you have been for a few months?
Yes, I would say we definitely still have very high conviction in equities, which we've had for a while, primarily driven by the chart you're showing on the left-hand side of this page, Ifin. I love that you're showing S&P 500 equal weight and S&P 500 excluding tech, because you can very clearly see the broadening in the equity markets. In other words, it's no longer a US tech story, though I would like to caveat that it is very much still a AI, US tech-driven capital spending story that is now diversifying into other parts of the US economy. In other words, we're seeing the externalities or the ripple effects of the CapEx spending that's happening in the US broaden from just the tech stocks into increased earnings and spending in other parts of the US economy that's leading to this broadening in the stock market. And then when we look at why we have such strong conviction still, we're looking at the fact that earnings are not just coming in as expected and really heady double-digit numbers for earnings even, but we're actually seeing earnings beat expectations, and earnings revision for the next several months are all positive. In other words, this is an environment where earnings are so strong, are projected to be strong, that we're seeing valuation improve in the US stock market.
And so this is all very positive. The fact that it's broadening, certainly all very positive. We've also, aside from this chart, seeing it broaden into mid-cap and small cap, which I think is clearly that kind of breadth we want to see up and down the cap spectrum. Just to reflect on we spoke about your positive position on EM. And we have this slide here which shows a bit of mixed picture on EM, but I'm going to put aside the negative for the moment. I think in terms of the positive side of EM, you mentioned earnings, and earnings are strong not only in the US, but EM has really shown very strong earnings growth estimates, higher than 30% on average. The world in general, and also Europe and UK, Japan, also showing positive earnings growth. So that's a very strong picture. We're also seeing this, the chart on the top right, in terms of how the indices have been performing. So strong, a lot of that tech-led, granted. And then on the other hand, we see in India, some of the tech stocks have perhaps been affected by AI disrupting their outsourcing model. So that perhaps is on the winners and losers side. But back to the winners, it seems that emerging market debt too is now commanding less of a premium. So there's actually there's a less compensation being commanded for emerging market risk. So how have we gone from this US exceptionalism dominant picture to inviting EM back into the fold again?
Right. So I would say that we are all sort of part of this AI trade. And you rightly pointed out that India is sort of underperforming because they are the outsource lot of software companies and areas which are ripe for disruption from the AI trade and the potential for AI to improve the productivity of this sector. But other parts of EM, all other parts of EM, including China, Korea, Taiwan, many of these countries are a huge beneficiary of the AI trade. So a lot of the chip manufacturing, a lot of the infrastructure that's needed for AI globally is being produced in EM. And China, as you see occasionally from headlines over and over again, is going toe to toe with the US in the AI race. The global phenomena that we are experiencing in earnings has a very strong AI fundamental base at the moment, and EM is also benefiting from it.
And do you think about the AI sovereignty question that many, certainly in Europe, European policymakers are thinking hard about over-reliance on US systems, defense systems, software systems, models, and seeking to build their own. And equally, there's this kind of arms race with China in terms of AI. Similarly, do you think that this certainly could be inflationary because if there is a desire to build locally, deglobalize, things will get more expensive? Do you think about this as being any way of a threat to the AI trajectory, that we've just moved so quickly in the US that things will start to maybe fracture?
That is a big debate at the moment, globally, I would say, and question of whether AI will become inflationary or deflationary. And we've given it a lot of thought in the team here. We have taken the view that it may be inflationary in the short term, but over long term, if the productivity anticipated from AI comes through, and if it is passed on to the right portions of the economy, in other words, it's not all absorbed in margins even, and if it's actually passed on to the consumers, then AI does have the potential to be a deflationary force. Right now, very short-term focus, it doesn't appear that way because everyone's focused on the enormous spend that we have on data centers, on setting up the electricity demands, and all the other things that you hear in the media about AI. But we are seeing here at Northern Trust the enormous benefit it can have to us for productivity. And we think that just accelerates over the next few years.
And it seems that based on where markets have gone this week, at least, as I said, the pocket of concern really isolated to the bond market, that there is not really much momentum, negative momentum within equities right now. It seems that with the small exceptions of the companies that have yet to go public, OpenAI being a good example, Anthropic seems to be heading for its IPO with strong revenue numbers, obviously high costs. I'd like to move to the credit side again, because I think this is an important indicator of maybe where some of the costs are being felt. We know that many of the AI hyperscalers have now moved into negative cash flow, at least on a kind of run rate basis. They are spending vast amounts on CapEx. They're forced to raise capital. And the yields have spread out somewhat. The yields that they're forced to pay are reasonably high. Good news for the private credit investor. I suppose there's still a bit of a lens that comes onto private credit from time to time. suggesting that maybe some of the K-shaped economy problems are actually being manifest in some of these defaults or lower performing loans. How do you think about this in a portfolio context and in terms of some of the potential weakness?
This is a great question, and I love that you're bringing up the topic of AI financing, because in our investment grade bond team here and in our high yield team, that is the one concern, even that did come up in our monthly investment policy meetings, where we sat around the table and said, economic growth looks amazing. Not just in the US and globally. And your previous chart showed that it is very much being felt in the economy. And we sat around saying, what can go wrong? Where are we seeing some canaries in the coal mine? And the topic that came up was around the spread widening that we are even seeing in the public markets, even not just the private credit market. Yes, you're seeing some of these. And if I pick through KKR and Golub and Blue All and all these, I can find sort of what may appear like idiosyncratic issues. Well, one of them is reacting to the software sell-off. One of them made a bad investment. I can pick through the individual names. But the biggest scorecard for the financing market is what's happening also in the IG market. So a lot of these hyperscalers are now having to issue enormous amount of debt. As you said in your introduction there, they have exhausted their free cash flow. Free cash flow is turned negative. They're going to the debt markets. And these are all great companies in terms of their ratings. You would think they will get close to treasury market yields on their debt, or they could issue it at close to investment grade. But if you look at all the hyperscalers and all the debt they have issued, that spread is now actually closer to double B. And we are writing about this a lot, and we were thinking about this a lot, and that was the one thing that's worrying us. You don't even need to worry about the opaqueness of the private credit and the data you'll get 3 months from now. But even if you just look at the public credit markets, you're beginning to see signs that markets questioning the amount of capex that they anticipate, which could over the next 3-4 years, could be as much as $5 trillion. They don't have the money for it. They're going to go into the public markets for it. And the public markets are beginning to question that will they be able to generate enough earnings from this to pay back the amount of medium to long-term debt that they are now raising. So that's something markets absolutely need to watch. You're beginning the spreads widen in the IG space. Again, still very close to long-term lows. But if you just look at this complex alone, you can see that the spread has started to widen. Close to double B.
Exactly. And I don't even have that chart this week. I had it last week. But I think that gives me some reassurance, because it tells me that there is not a kind of a blind following of this momentum going on. I mean, the fact even that private credit has been picked over now for months, if we go back, that these stocks have sold off, they haven't been participating in the market upswing. It shows me that investors, stock pickers, are discerning. They're not. They're finding winners and losers. Even going back to the previous chart about India, there is a real discernment going on in the market in terms of winners and losers, and it's not all one way. And I think that is reassuring, because what are we doing as allocators but looking for the next trigger of the next market collapse, I suppose, or at least market correction. So I think it's really quite a healthy thing that we are seeing this level of discernment across the AI story. Thank you so much, Anwiti, for joining us and for cycling through at a whistle-stop pace the various topics that we discuss. Delighted to have you here on the Markets Happy Hour podcast.
Thank you for having me, Ethan.